Silver is reopening tonight, and something doesn't add up. After trading around $73 and showing neutral signals on technical indicators, traders are still selling into strength. That's not normal. And if you ignore this move, you could be on the wrong side before Monday even begins. And if you're not paying attention before the market reopens tonight, you could miss a move that may redefine the next phase of this market. Because what looks like strength on the surface could be hiding something very different underneath. Take a step back for a moment. As of today, April 5th, 2026, silver is not crashing. It's not breaking out either. It's hovering, stabilizing after weeks of volatility. And historically, this kind of behavior doesn't last. It resolves, usually when liquidity returns. Now here's where things start to get uncomfortable. Because if you zoom out just slightly, the context changes completely. Silver didn't just move recently, it exploded. In 2025 alone, silver surged more than 140%, one of the strongest commodity rallies in decades, driven by supply shortages, industrial demand, and safe haven buying. By early 2026, it pushed into extreme territory, even touching levels above $100 at peak momentum before correcting sharply. That kind of move doesn't happen quietly. It attracts attention. Retail traders, institutions, speculative capital, and when too much capital enters too quickly, markets don't just continue, they transition. Now this is where most people misunderstand what's happening. Silver is not just another commodity. It's a hybrid asset, part industrial metal, used in solar panels, electronics, electric vehicles, part monetary asset, reacting to inflation, interest rates, and global uncertainty. And because of that, it doesn't move based on one story. It moves based on multiple forces colliding at the same time. Right now, those forces are not aligned. On one side, you still have strong long-term fundamentals. The Silver Institute continues to highlight structural supply deficits in the market, even as demand remains resilient. That's bullish. But on the other side, you have macro pressure building. The International Monetary Fund tracks global commodity cycles closely, and recent data suggests that tightening financial conditions and slowing global growth could weigh on commodity prices broadly. That's not purely bullish. And when those two forces collide, you don't get a clear trend. You get volatility. Now focus here, because behavior matters more than narrative. Over the last few sessions, silver has shown signs of strength, short-term bounces, temporary recoveries, but something is missing: follow-through. Instead of aggressive buying, we're seeing something else: selling into strength, not panic selling, not a collapse, controlled selling. And historically, that kind of behavior tends to show up when larger players are adjusting exposure, not reacting emotionally, but managing risk. Let's talk about risk for a second, because in markets like this, risk is not just about direction. It's about liquidity. Liquidity is what allows markets to move smoothly. It's what allows institutions to enter and exit positions without creating sharp disruptions. And when liquidity becomes uncertain, markets behave differently. Central banks play a massive role here. The Federal Reserve, the European Central Bank, global monetary authorities. They control interest rates, money supply, and financial conditions. And right now, those conditions are shifting. Inflation is still present globally, even if it's no longer accelerating at the same pace. Interest rate expectations are constantly changing. And policy direction is no longer clear. That creates hesitation. And markets don't like hesitation, because hesitation leads to one thing: repositioning. Now connect this: when you see traders selling into strength, at the same time, macro conditions are uncertain. It may not be random. It may be strategic. Let's zoom out again, because silver doesn't move in isolation. Historically, silver performs best when inflation expectations are rising, real interest rates are falling, and the US dollar is weakening. But in 2026, that relationship is not clean anymore. Real yields are fluctuating. The dollar is unstable, but not collapsing. Inflation is persistent, but uneven, which means the macro backdrop is no longer clearly bullish. And when the macro story becomes unclear, markets shift from chasing momentum to managing risk. And that's exactly what we may be seeing right now. Pay attention, because the market doesn't need to crash to hurt traders. It just needs to move differently than expected. Slow moves, fake breakouts, sharp reversals. That's how positioning resets happen. Now let's go deeper, because this is where things become even more interesting. After that massive rally, silver entered what analysts call a price discovery phase, meaning there were no clear resistance levels, no historical reference points, just momentum. And historically, price discovery is followed by normalization, not always a crash, but a transition. In fact, recent market outlook suggests that after such a strong rally, silver may face mean reversion risks in 2026, with returns potentially cooling as markets rebalance. That doesn't mean the long-term story is broken, but it does suggest something important. The easy part of the move may already be behind us. Now think about timing, because this is happening right before the market reopens tonight. Weekend positioning matters. Liquidity shifts matter. And how traders position themselves before a new session can reveal expectations. And right now, the behavior suggests caution. Not panic, but caution. What if this isn't just profit-taking, but early repositioning? Because if that's the case, then the next move may not follow the narrative everyone expects. Now let's connect another layer, because silver demand is not just financial, it's industrial, used in solar panels, electronics, electric vehicles. And while that demand remains strong, there are early signs of adjustment. Industrial demand is expected to soften slightly in 2026 as manufacturers adapt to higher prices through substitution and efficiency improvements. That's not a collapse, but it's a shift. And markets react to shifts, not just extremes. Now combine that with supply. Global silver supply is expected to increase modestly, reaching higher output levels compared to previous years. Again, not bearish alone. But when combined with softer demand growth, it changes expectations. And markets trade expectations, not headlines. Now step back one more time, because this is where the bigger picture comes into focus. This isn't just about silver. This is about global capital flow. When global growth slows, liquidity tightens. When liquidity tightens, risk assets behave differently, and silver sits right in the middle of that transition. What if the recent strength was not accumulation, but distribution? What if this phase is where larger players are quietly reducing exposure, while the narrative remains bullish? Because if that's true, then the next move may not be obvious, and that's exactly what makes this moment important, because the market hasn't confirmed direction yet. But behavior is starting to shift, and when behavior shifts before price, that's when you need to pay attention the most. So as the market prepares to reopen tonight, watch carefully, not just price, but behavior, because the real signal is not in the headlines. It's in how traders are positioning right now. And if you understand that, you won't just react to the next move, you'll be ready for it. Now let's go deeper, because this is where the real story begins to unfold. What you're seeing in silver right now is not just price movement, it's a reflection of something much bigger, a shift in liquidity, a shift in expectations, and possibly a shift in how markets are preparing for what comes next. Because if you look closely, silver is no longer reacting only to demand and supply. It's reacting to policy. And policy is becoming unpredictable. The Federal Reserve, which controls the cost of money globally, is no longer in a clear direction. Markets had been expecting rate cuts in 2026. That expectation helped fuel the rally. because lower interest rates historically make non-yielding assets like silver more attractive. But now, that expectation is being questioned. Inflation has not disappeared, energy prices are still volatile, and central banks are becoming more cautious again. In fact, recent market signals suggest that hawkish expectations are rising once again, meaning interest rates could stay higher for longer than expected. And that changes everything. Because when interest rates stay high, liquidity tightens. And when liquidity tightens, markets don't behave the same way. This is where silver becomes extremely sensitive, because unlike stocks, it doesn't generate income. It depends on capital flows. So when capital becomes more expensive, silver faces pressure. Now combine that with currency dynamics. The US dollar still remains one of the most important drivers of silver. When the dollar strengthens, silver becomes more expensive for global buyers. Demand slows, pressure builds, and right now, we are seeing exactly that relationship playing out. Recent movements show silver struggling around the $70 to $73 range, partly because of dollar strength and safe haven demand shifting back into currency markets. This is not a collapse, but it's not strength either, it's resistance. Now think about positioning again, because this is where the pieces connect. If traders believe liquidity will tighten, if they believe interest rates may stay elevated, if they see the dollar stabilizing, then holding large silver positions becomes riskier, not because silver is weak, but because the environment is changing, and markets always price the environment before they price the asset. This is why you're seeing selling into strength, not because traders are bearish long term, but because they are uncertain short term. And uncertainty is the most powerful force in financial markets. Now let's take this one step further, because this is where institutional behavior becomes critical. Large institutions, banks, hedge funds, asset managers, they don't react like retail traders. They position ahead of events. They don't wait for confirmation. They anticipate shifts. And historically, when institutions begin reducing exposure quietly, it doesn't show up immediately in price. It shows up in behavior, slower rallies, weaker breakouts, stronger resistance levels. That's exactly what we are seeing right now. And here's where it becomes even more interesting. Because despite all this, the long-term narrative has not changed. The Silver Institute still expects a structural deficit in the silver market, meaning demand continues to exceed supply for the 6th consecutive year. That should be bullish, and it is long-term. But markets don't move only on long-term fundamentals. They move on short-term positioning. And right now, short-term positioning is shifting. Now let's talk about volatility, because this is where many traders underestimate the risk. Silver is historically one of the most volatile major assets. It doesn't move gradually, it moves aggressively. We've already seen that in 2026, after hitting extreme highs above $120 earlier this year. Silver dropped sharply, entering what analysts described as a bear market phase within days. That kind of move is not normal. That's not just supply and demand. That's positioning unwind. And when positioning unwinds, it rarely happens in one move. It happens in phases. Phase 1, sharp correction. Phase 2, false recovery. Phase 3, decision point. And right now, we may be entering that decision point. This is why tonight matters. Because when the market reopens, liquidity returns, volume increases, and real positioning begins. This is when signals become clearer. Now imagine this scenario. The market opens. Silver pushes slightly higher. Looks strong. But instead of continuation, it stalls. Selling pressure increases. Gradually, then suddenly. That's not random, that's distribution. Or the opposite happens. The market opens. Silver breaks higher aggressively. Momentum returns. Buyers step in. That's not random either. That's continuation. And right now, we are right between those two outcomes. This is why traders are cautious, because the next move will define the direction. Now step back again, because this is where macro and behavior fully connect. Global markets are entering a phase of uncertainty. Growth expectations are slowing, policy direction is unclear, geopolitical risks remain elevated, and in that environment, capital doesn't move aggressively, it waits. And when capital waits, markets become unstable, not necessarily crashing, but unpredictable. And silver is one of the first assets to reflect that instability. So when you see traders selling into strength, it's not always fear. Sometimes it's preparation. Preparation for a move that hasn't happened yet. And that's exactly where we are right now. So as the market prepares to reopen, watch closely, because what happens next may not match what you expect. And if you understand that, you'll start seeing the market differently, not as random movement, but as positioning in real time. Now imagine this. The market is about to reopen. Screens light up. Liquidity starts flowing back in. Orders begin to stack. And for a brief moment, everything feels calm. Then suddenly, price moves. Not aggressively, not dramatically, but just enough to pull people in. Silver ticks higher, small green candles, momentum building, slowly. And this is where the trap begins. Because at first glance, it looks like continuation. It looks like strength. It looks like the next leg higher is starting. But beneath that movement, something else is happening. Orders are getting absorbed. Buyers are stepping in, but sellers are meeting them. Quietly, not crashing the price, not forcing a breakdown, just absorbing demand. This is what distribution looks like. And it doesn't happen loudly, it happens slowly. Now think about what we've already seen this year. Silver didn't just move up, it surged to extreme levels, then dropped sharply, then rebounded again. This is not a stable trend. This is a volatile cycle. In fact, analysts have already highlighted that silver's volatility is significantly higher than gold, driven largely by speculative positioning and thinner liquidity. And that matters, because when volatility is high, moves become exaggerated, upside becomes explosive, downside becomes violent, and most importantly, false signals become common. Now combine that with what's happening globally, because silver is not moving in isolation. Geopolitical tensions remain elevated. Energy prices are unstable. Central bank policies are uncertain. And all of this feeds into one thing: market hesitation. When markets hesitate, they don't trend cleanly. They move in waves, sharp rallies, sharp pullbacks, temporary recoveries. And that's exactly the phase we are in right now. Now let's go deeper into smart money behavior, because this is where most retail traders get completely blindsided. Large institutions don't chase price. They create liquidity events. They need buyers to sell into, and they need sellers to buy from. So how do they do that? They allow the market to move just enough to create confidence, a small breakout, a slight push higher, a moment of optimism. And then they adjust their positions, not all at once, not aggressively, but gradually. This is why you don't see a crash. You see hesitation. Now look at what's happening in silver right now. Price is hovering around the low 70s, after dropping nearly 20% from its peak earlier this year. That's not just a correction, that's a reset. And resets don't happen randomly. They happen when positioning becomes crowded. Too many buyers, too much optimism, too much expectation. And when that happens, the market needs to rebalance. Now here's where things get even more interesting, because despite this correction, the long-term narrative is still bullish, demand remains strong, supply deficits continue, industrial usage is still rising, but price is not reflecting that fully, and that divergence is where opportunity and risk both exist. Because historically, when fundamentals and price diverge, it means one of two things. Either price catches up later, or expectations adjust downward. And right now, The market is deciding which one it will be. Now bring this back to tonight, because timing matters. When the market reopens, we're not just watching price, we're watching reaction. Does silver break higher and hold, or does it push up and then fade? That difference is everything, because a strong breakout with follow-through signals continuation, but a weak breakout that fades signals distribution. And right now, the conditions suggest caution, not because silver is weak, but because the environment is uncertain. Now, let's add one more layer. Global commodity markets are showing signs of instability. We've already seen sharp sell-offs earlier this year, driven by stronger dollar conditions and shifting geopolitical expectations. And when commodities move together, it usually means something larger is happening. A shift in capital flow, a shift in risk appetite, a shift in liquidity, and silver often reacts faster than most assets. Now think about the bigger cycle, because this is not the first time we've seen this pattern. In 2011, silver surged rapidly, then collapsed. In 2020, it rallied again, driven by stimulus and liquidity, and now in 2026, we're seeing another cycle, driven by monetary policy uncertainty, geopolitical tension, industrial demand. But this time, the environment is more complex, because liquidity is not expanding freely, it's tightening. And when liquidity tightens, markets don't move smoothly, they move unpredictably. Now ask yourself this: if the market was truly confident in the bullish narrative, would traders be selling into strength, or would they be aggressively adding positions? That question alone changes how you look at this market, because sometimes the most important signals are not what the market is doing, but what it's not doing. And right now, silver is not showing strong continuation, it's showing hesitation. And hesitation is where reversals begin, or where explosive moves are prepared. This is the uncertainty zone. This is where traders get trapped, because both sides can be wrong. Now as the market reopens, watch closely, watch how price reacts to strength, watch how it behaves at resistance, watch how quickly momentum fades or builds, because the next move will not just be another move. It may define the next phase of this cycle, and if you're not paying attention, you won't see it coming. Now everything comes down to this moment. The market is about to reopen. Liquidity is about to return. And what happens next may define the direction of silver for the coming weeks, because after everything we've seen, the massive rally, the sharp correction, the unstable recovery, we are no longer in a trending market. We are in a decision phase. And historically, decision phases don't last long. They resolve. But the direction of that resolution is what separates opportunity from risk. Let's break this down clearly, because right now there are two possible paths. The first scenario is continuation. If silver opens strong, if buyers step in aggressively, if price breaks above recent resistance and holds, then the market may be preparing for another leg higher, and this would not be unrealistic. Major institutions like JP Morgan have suggested that silver could average around $80 per ounce in 2026, with upside potential toward $90 to $100 under favorable conditions. That scenario depends on several factors aligning: lower interest rates, weaker dollar conditions, sustained industrial demand. If those conditions improve, silver could regain momentum. But here's the problem. Those conditions are not fully aligned right now. Which brings us to the second scenario: distribution followed by another leg down. And this is the scenario many analysts are quietly watching, because after such an extreme rally, markets don't always continue immediately. They often correct, sometimes deeply. In fact, some market analysts have already warned that silver's explosive rally may have peaked, with potential for prices to fall back into the $40 to $75 range if conditions weaken further. That doesn't mean it will happen, but it does show you something important. Uncertainty is high, and when uncertainty is high, volatility follows. We've already seen this play out. Silver dropped more than 5% in a single move recently, as investors reduced exposure amid geopolitical uncertainty and shifting expectations around central bank policy. And that's the key word: expectations. Markets don't just react to what is happening, they react to what might happen next. Right now, those expectations are shifting. Inflation is still present. Energy prices remain unstable. Central banks are becoming more cautious again. And that creates pressure because silver does not exist in isolation. It is deeply connected to global liquidity. When liquidity expands, silver benefits. When liquidity tightens, silver struggles. And right now, liquidity is uncertain. Now let's go even deeper, because this is where the final piece comes together. Silver is not just driven by fundamentals. It is driven by behavior, and behavior is starting to shift. We've seen strong rallies fail to continue. We've seen resistance hold. We've seen selling into strength. These are not random signals. They are early indicators of positioning change, and positioning is what moves markets. Now think about this. During the rally, retail investors flooded into silver. ETFs saw strong inflows. Physical demand surged. That created momentum. But momentum doesn't last forever. At some point, early buyers take profits. Late buyers enter. And the market begins to rebalance. That's where we are now. And this is where the risk increases, because late-stage markets are not predictable. They are reactive. Small changes in sentiment can lead to large moves in price. Now bring this back to tonight, because tonight is not just another session. It is a transition point. The market will show its hand. Either buyers step in with conviction, or sellers take control quietly. And the difference between those two outcomes will define the next move. Now here's what you need to watch. If silver moves higher, but volume remains weak, that could indicate lack of conviction. If silver breaks resistance, but quickly reverses, that could indicate distribution. But if silver breaks higher and holds with strong participation, that could signal continuation. These are not guarantees, but historically, these are the signals markets leave behind. Now step back one final time. Because this is bigger than silver, global markets are entering a period of adjustment. Commodity volatility is rising. Policy direction is unclear. Geopolitical risks remain elevated. And in that kind of environment, markets don't move in straight lines. They move in waves, unpredictable waves. And silver is one of the most sensitive assets to that shift. So when you see traders selling into strength, don't assume it's weakness. It could be preparation. Preparation for a move that hasn't fully revealed itself yet. And that's what makes this moment important, because the next move will not just be another move, it may set the tone for what comes next. So before you follow the crowd, before you assume the trend is still intact, ask yourself one question. Why are experienced traders reducing exposure right before the market reopens? Because the answer to that question may already be reflected in the market, just not in the way most people expect. And that's the part most people miss.